Hi guys. Okay, I want to go ahead and put up the practice midterm lecture, get that done for chapter 17, and you'll also be able to see the markup file, assuming that I don't have a problem with Word saving the file after I mark it up. I'll try to get that up there as well. So let's just go ahead and take a look here, and I just want to make sure my recording is doing its thing. Okay, which it is. Okay, good. All right, and so I just want to take a look at these questions, and remember, in this chapter we're dealing with investments, right? And so for this first one, we're seeing this entity has a trading security and available for sale security. Now, when we look at the question, they ask us what should be reported in the income statement. That being the case, I know I have to focus on this trading security because unrealized holding gains and losses that they're asking me for, right? That means I held the security, I haven't sold it yet, but I have to report unrealized holding gains and losses. And in the case of a trading security, that information is reported on the income statement. I ignore this information. I'm just going to strike it out because this would be reported as what? Other comprehensive income, right? And so that's not reported on the income statement. That's reported on the statement of, and it would either be the statement of comprehensive income or the statement of other comprehensive income, depending on whether I use a one-statement approach or a two-statement approach for reporting that information. But income statement is reserved for items that are not part of my OCI, just exclusive to income, right? So I start to take a look at this question, and I see that the security has what? Has a cost of 150. And at the end of year one, a market of 100. Now, let's just review what would happen in year one. Okay, in year one, I would have gone ahead and I would have debited what? Debited the, looks like debited the unrealized loss. And I would have debited that for what? For 50,000, right? That's the difference between the 100 and the 50. And I would have credited the security. We'll just do the security. I'm not going to use valuation allowance here. Debited the security for the 50,000. Okay, so what would happen? So if we just looked at the security account, it started out with the 150. I'm not going to put the entry when I bought it. I would have debited security, credited cash. And then I just credited it for 50,000. So at the end of year one, I'm just going to put it here, there's a $100,000 balance sitting there, right, at the end of year one. Now what happens? By the end of year two, this thing has come back, and it's come back past 50,000, 150,000, it's all the way to 155, okay? So what I'll do is I will now debit security for 55,000, and I will credit now unrealized gain for 55,000. Okay, and so what happens when I debit the security for 55,000? We now see how the security ended up getting reported at 155,000 at the end of year two through those set of journal entries, right? Now, I did all this just to sort of understand, how we got the answer, I guess, the long way, which was this 55,000. And this funny format is from CPA material. So this was actually a CPA exam question. And but what's interesting here, the way to actually have worked this, I don't know how interesting it is, but you will look at what the difference between what the security was carried at the end/beginning of the year versus what it is carried at the end of the year. I say end slash beginning, end of year one, start of year two. So the start of year two and the end of year two, that difference is what ends up being calculated as the gain in a trading security like this, or it could be a loss if it had gone down. If they'd asked me this for year one, it'd be a loss of 50,000. Okay. Okay, good. Let's go ahead then and then kind of show you that kind of quick. Should have probably had that up while I was saying that. That quick way of doing it would have been right there. Okay, but I'm just showing you over the life, the 2 years of the security, that's how it would have gotten there. Okay, good. Let's go ahead and take a look at this. And we say, which of the following investments held by Zoogle may be classified as held to maturity? Well, if it's held to maturity, first of all, it's got to be a debt security. It's got to be a bond. And the company has to have the positive intent and ability to hold it to maturity. So I look, and I don't have to search very long before I find the right answer. All of these others, of course, it's not all of them, are stocks. And stocks do not have categories that we put them in terms of being the trading, available for sale, held to maturity. That's reserved for debt securities, right? Okay, good. Number two, which of the following investments held by, here's our buddy Zoogle again, are reported at fair value in its balance sheet? Well, that's going to be what? Our trading debt securities, are available for sale debt securities, and then our stocks, right? Okay, so we come and we take a look here and we have what? We have debt securities held as available for sale are going to be, I said it backwards. I said which, I always make that mistake where it says not, and then I give you the answer of the ones that are. The ones that are the categories that I just gave you. So anything not in that category is, okay, let me start over here. I think I'm confusing myself, so pretend I'm just start over here, okay? Which of the following investments are not reported at fair value? Okay, well, the ones that are reported at fair value are going to be trading, are going to be available for sale, and then our equity securities. Our debt securities are not reported at fair value. Our held to maturity debt securities are not reported at fair value. And so you take a look, and that's the answer here for B. Debt securities that are held to maturity are carried at amortized cost. Trading and available for sale, okay, and it's not all of them, obviously, those are fair value. The only difference between the trading and the available for sale, trading, unrealized gains and losses are run through the income statement. Available for sale, unrealized holding gains and losses are run through the statement of comprehensive income. Okay? Okay, good. Now we say questions 4 through 6, and I don't think this reconciles to the numbers on the next two questions, or we're missing 3 anyway. Okay, so our numbering's a little off. I might have deleted question 3. But they ask us now to look at what's going on with these securities based on this table of information. Okay, so the first thing says, what balance sheet amount should Bedsford report for the total of its investment in debt securities? Okay, now depending on the category, as we just saw in that previous question, it's either going to be amortized cost or fair value. And for my held to maturity securities, okay, and make sure you're good with the dates on this question. That's an easy mistake to make. They sit there and they tell me at 12/17 it has an amortized cost of $367,500. Okay, good. So I'm going to pick up amortized cost for those securities because they are held to maturity. Okay, then I go ahead and I start to look at my trading security category, since that's the next one up. And again, pay attention to your dates. They're saying what? 12/31/17 is what the question asks. So I got to go to this column. But now I go to what? I go to fair value, because again, trading and available for sale securities are carried on the balance sheet at fair value. So I went ahead and added those guys up, and that comes to $139,000. Okay, so now I've got to put that with the amortized cost for the held to maturity security, right? Then I come over, and this problem only made me do some grunt work here for just that trading security. Fortunately, there was only one security in the other two categories, and that's my available for sale. Again, I always like to check that date, and that one you can see there is having a fair value of 130,500, and since it's an available for sale, I'm going to pick up the fair value. Okay, don't know why that's happening. Okay, but let's just go ahead and total these three numbers: 367, 139, 130,500. And when I do, I get what? 637,000, which is choice A. Okay. All right, good. That's kind of a fun problem, right? Okay, let's go ahead and now look at what happens in this next question. Again, we're still using the same set of facts here now. And what we've got is the question, well, what should be an accumulated other comprehensive income? And of course, now we're going to have to limit our analysis here to the available for sale security, because that's the only one that affects the accumulated other comprehensive income. So what I did for this problem is I just went ahead and teed up my accumulated other comprehensive income, because that's what they're asking me account about. And I'm going to analyze this and see what happens. And I'm going to go through and analyze it over the couple of years that are related to this available for sale security. So they buy the security. I'm not sure exactly when they bought it, but I'm just assuming they bought it in 2017 at a cost of 140, and then it turns out that at the end of 2017 this thing has fallen in value. So I would have debited unrealized loss. Unrealized loss, remember, on an available for sale security gets reported on the statement of comprehensive income, and of course I go ahead and I credit the investment for 9.5. Okay, now just to make sure we're keeping track of the investment too, why don't we go ahead, we're going to tee that up. I guess I'll just tee it up right here, I guess. I'll get you be able to have some room here. So investment for this available for sale security now, that's for the AFS security, right? This one right here. Okay, it originally cost him 140. And if we look at this, they're crediting it for 9,500. So now I know, and I can just peek over here, they're carrying it at 130,500, right? Okay, good. Okay, so now what happens? Now I have to close my unrealized loss on this, because our other comprehensive income, all income accounts, get closed during the year, whether they're regular income or other comprehensive income, right? So I've got to close those. So I go ahead, and since I debited the loss here, to close it, I credit it, and I debit my accumulated other comprehensive income, all right? Okay, good. Then I go into my second year, because again, the question asked me, got to watch what year they're asking me, 2018. Okay, and so they're asking me 2018. So now I look and I say, well, okay, in 2018, the things come back from this, what, 130,500. I got to bring it up to 150,400. So what do? Well, now I'm going to debit the investment. You can check my math on this. I debit the investment, what? Debit the investment 19.9 and credit my unrealized gain. Again, that unrealized gain, I'm going to just put OCI on the edge there. Hyphenated OCI, okay, is 19.9. Okay, and I'm crediting that 19.9. That's part of my other comprehensive income. So when I debit this now, 19,900, okay, now the balances, and I probably shouldn't write my balances on in the debit credit columns, because that's confusing. So it was what, 130,500, and then when I debit it, just turning this more into a ledger card, now the balance, if I did my math right, should come to 150,400, right? 130,500 plus 19,900, yeah, 150,400, which is what I want, okay? Then when I close this, again, gotta close these accounts, okay? We're really moving down the file here to get all these journal entries in. I debit unrealized gain, OCI, that closes that, 19,900, and I credit the investment. 19,900, that's trying to be a credit. The bane of my existence is trying to squeeze everything on these files. Okay, so that's a credit, 19,900, right? Debit credit. Yeah, that's easier. Okay, and so that's that debit right there. I've already posted that. So then I go ahead and not investment, but I credit. I credit my. I already debited it right there, John. Okay, I'll be glad when I'm done with this problem. Okay, and I go ahead and I credit OCI. I'm closing it to OCI for 19,900. Okay, and so I go ahead and I stick that credit into my accumulated other comprehensive income. And the ending balance now is what? 10,400, if I'm doing my math right. Okay, and I'm writing that on the credit side. The credits are more than the debit, so I have a balance of 10,400. And so now I look, and yeah, that's right. They tell me that the balance, I get the correct answer here, C, 10,400. Now, what's interesting here is the balance that is going to be in this account is whatever is necessary, okay, to bring the security from whatever its original cost was to what it is being carried at now, okay? So I really did more work than I had to here. All I really needed to do was look at the difference between the 2018 fair value and the original cost. That's the amount that needs to be adjusted to the investment to get it to be at the value that I want it to be, and that amount is also what gets reflected in the accumulated other comprehensive income at any one point in time. But I just sort of walked you through how we got there. Okay, but if you're working, in the exam or something, it is pretty easy to just sit there and look at the difference between the cost and whatever date they're asking you to tell you what's in the accumulated other comprehensive income, the fair value at that date. That's the amount that you need in the accumulated other comprehensive income. Okay? Okay, good. On this next one, what total unrealized gain should Bredsford report in 28 relative to its investment in debt securities now? And we start to take a look at this one here. What unrealized holding gain should Bedford report in its income statement? Income statement 2018. That means we are looking at what? That means we're looking at trading securities here. Okay. We come up, we look, we've got these what? We've got these trading securities, and we've got a little bit more heavy lifting to do on this question. Because now we're going to have to analyze the difference between the fair value at the beginning of 2018, which is the end of 17, and the fair value at the end of 18, okay? So we start to look at these and we see, well, this one, I'm just going to put another column in here. Okay, this one, of course, it's going to make me fight to get my column in there. Okay, this one is up what? This one's up 11.5 for that DEF, whatever. This next one has what? Has come up 30. And this last one looks like it's come down, what, 5? Of course, you'd have to calculate each one of these. You'd use a calculator. I already had done the work ahead of starting this video. And then I go ahead and when I do the math on this with my calculator, I get 36,000 up. Okay, so this thing has increased 36,000, choice B. Okay, all right, good. So you can see that a question like that has a fair amount of work and some sophistication as to what's going on with these different things. But again, a lot of the times the difference is just comparing for the trading securities, comparing the amount at the beginning of the year to the end of the year. For my held to maturity securities, there are no unrealized holding gains and losses, so that's good. And then for my available for sale, if they're asking you any point in time, what's the amount that the security should be, that they should be in the accumulated other comprehensive income, it's the difference between the cost and the fair value, whatever date they're asking you. Okay? All right, good. So go back through that. I think that question, I don't know that I would give you something quite that tough on your exam with all the different categories moving in different directions and stuff, but that is a good review as to how we treat the different categories in a nice comparison. Okay? All right, good. Number 7 here. Okay? On January 1st, 2018, Rupar retailers purchased 100,000 of Anand Company bonds at a discount of 5,000. Okay, so if it's a discount, remember from chapter, seems like a long time ago now, right? Chapter 14. Okay, we have what? We have the 100,000. We subtract 5,000 for the discount, right? They bought it at a discount of 5,000. So that means they purchased the bond for 95,000. Okay, now just to sort of look at the answer here, there's the journal entry when they purchased the bond, right? Okay, good. Now what happens? Well, the carrying value of this bond, though, is what? Is 95,000 upon issue. And they tell me that the bond pays 6% interest, but were purchased when the market rate was 7%. So there's my effective rate, okay? Even though the cash that they're going to pay is going to be predicated or based on this 6%, okay? The bonds pay interest semi-annually, January 1st, July 1st. Rupar accounts for the bond as held to maturity investments. Good. I'm not going to have to make any adjustments to market value. I'm just carrying it at amortized cost, and uses the effective interest method. In Rupar's December 13, 2018 journal entry to record the second period of interest, we would credit interest revenue of, and guys, when you get asked a question like that and they ask you about the journal entry and whatnot, and credit, debit, my advice to you is make all the journal entries, okay? Just take your time. You're going to have plenty of time when you're working an exam. Make all the journal entries. When you're working my exam, you're going to have plenty of time to do it. Just work through the journal entries. So they're asking me what? They're asking me the 1231 journal entry, but there would have been a journal entry because it's a semi-annual bond, so there would have been one on July 1st, okay, or June 30th, whatever. So I go ahead here and I debit my cash, okay, and the debit to cash is based on the face times the coupon stated rate of interest, contract rate of interest on that. And so I go all synonymous terms, so I'm going to debit cash 3,000. Then I have to figure out what is the amortization on the discount, and it's the difference between the interest revenue at July 1st, June 30th, okay, which is the 95,000 times the market rate of interest times 1/2, okay? So that gets a little bit weird looking. So let's just do it this way. 95,000, the carrying amount of the bond, times what? Times 7% times 1/2 is the way us humans write that. Okay. And so that gives me interest revenue in July of $3,325. Now, if you pay $3,000 cash, that means you have amortized that discount, what? $325. And remember, we take discount amortization and we add it to that previous carrying value. So now we've got $95,325 as my interest, as my carrying value for the next 6 months. So now what do I do? Well, again, I'm going to go ahead and multiply that times 0.07 times 1/2 to get my December 31st interest. And when I do, let's just double check my math. 95,325 times 0.07, okay, divided by 2 gives me what? 3, okay, that equals 336 and what? 3,336 and 37 cents. Okay, and so at 12/31, what this question was asking me, again, I debit cash. The difference between the cash and this interest is the amount of discount amortization, 336 in this case. So they go ahead and they debit the discount for that, debit the discount for the difference, and then they go ahead and they credit the interest. They're using discount here. I think in the lecture we were taking those amortization and the discount and adding them straight to the investment account. But you could use a discount account. I like to just put it straight into the investment accounts. But anyway, we got the answer to the question, what? Right here. We really didn't need to make the whole journal entry, I guess. But I like to go ahead and make sure I know what I'm doing with an entire journal entry when they ask me about a debit or a credit that constitutes an entire transaction. I don't like to have to sit there and kind of, picture the journal entry in my head and figure out where the debit is, the credit is. I like to do the whole journal entry. Okay. All right. Good. Let's go ahead then and let's take a look. And notice, guys, the income impact for, I probably should say, for an available for sale, for a held to maturity security is going to be just the interest part. There's no unrealized holding gains and losses being calculated anywhere on a held to maturity security. Good. Okay, good. The income statement reports changes in fair value for which type of investment? Securities under the equity method? No, we're going to talk about that. That's going to be basically based on your share of the earnings that come out of your investee minus any dividends that have been paid out. Trading security, yeah. Held to maturity, those are not going to affect the anything, either comprehensive income or net income. And available for sale, we would carry them at fair value, but those changes are not reported in the income statement. Okay, that's just our trading securities. Okay. Okay, good. So we come over and they talk about Anthers bought the following portfolio of trading securities, blah, blah. What amount will be reported in the balance sheet for this portfolio at December 31st, 2018? And how will it be classified? Well, since it's trading securities, I have to pick up the fair value column. And when I add up that fair value column, I get 160,000. Because I carry those at fair value. And we say that trading securities are typically carried as what? So I know it's either C or D, and trading securities are typically carried as a current asset. Okay, that's the whole point of a trading security. The idea is that what? You're actively trading those on the market, so you should be reflecting fair value because that's really going to be the transaction price that you'll be doing with this in the near term. Thus, it's a current asset and it makes sense that unrealized holding gains and losses should flip through the income statement because that's a more current, there's a more current dynamic associated with the trading security category. Thus, things go through the income statement, it's carried at fair value, and it's reflected as a current asset. Okay. All right, good. Let's go ahead and let's take a look at number 10. And we say GAAP regarding fair value accounting for investment in equity securities will generally apply to an investment when the percentage of ownership of another company, fair value accounting for its investment in equity securities. We do that when we are less than 20%. When we go past 20%, we're supposed to use what method? Equity method. Now this is for our equity securities, our stocks, okay, not our bonds. We've been talking about bonds really as we've been talking about the categories here, held to maturity trading, available for sale. Now we're starting to creep into the part of the discussion now that dealt with equity securities, okay? So let's go ahead and take a look at this next one. When an investor accounts for investment in common stock at fair value through net income, cash dividends are classified by the investor as what? Income. That's our dividend income. Okay. So for our stocks, where we're under the 20%, where we're using the fair value method, account for them on the balance sheet at fair value now for the stocks, right? We've already talked about the debt. Now for our stock investments, carry them at fair value. And what the income streams are going to be dividends, and of course the change in fair value, and those changes in fair value go straight to the income statement for our equity securities under the fair value method for accounting for those. Okay, now you come over and you take a look, and okay, we've flipped you back to debt securities now. Okay. And so for number 12, we take a look, and they want us to tell them how should the corresponding losses be reflected in the financial statement. So I'm going to have to look at each of these now. And so what happens? For the trading, I had cost of 60, fair value of 54. So I guess I got a loss there of 6,000. And for the available for sale, I had a cost of 110 and a fair value of 107. So yeah, they're right. There's a loss on both of those. And that is $2,500 on that loss. Okay. So I look, and the losses, C, 6 for the income statement, because that's where trading securities go, report their gains and losses, and and 2,500 talking about now. That's a little funky the way they're doing that, you know, because they ask you about the balance sheet account here. But remember, we would report, I'm just going to show you right now because this is, we kind of keep talking about this. And okay, we have what? We have our, I'm going to call this the statement of comprehensive income. Okay, and I know you learned this in another class, but it won't hurt us to review the statement of comprehensive income. Comprehensive income by definition, comprehensive income is what? Net income plus OCI. I mean, only an accountant talks like this, guys. When you start talking like this, you have passed into the world of being an accountant, okay? So what happens? Our comprehensive income is our net income plus our other comprehensive income, okay? So when we do a statement of comprehensive income, we have to report and of course we report our net income, the revenue, expenses, okay, non-operating items. And our non-operating items would be this loss on this trading security. Okay, so that's going to be what? $6,000. That's a loss, right? And so our net loss that's reported would be this 6,000. Then we keep going and we'll report our comprehensive, our OCI, other comprehensive income. And we again have what? We have this loss here, and this loss is, we determined was 2,500. So we report that, and assuming there were no other items here, then our comprehensive income, that's this comprehensive income. Our comprehensive income, that says comprehensive income, is going to be what? Or it's comprehensive loss, I guess, 8,500, right? Okay. Now, what happens, though, is we close our regular income loss to retained earnings. Our other comprehensive income loss gets closed to accumulated other comprehensive income. So this part would go to retained earnings when we close everything. This part goes to accumulated other comprehensive income. So I sometimes tell my students that accumulated other comprehensive income is like the retained earnings of other comprehensive income. That's where our other comprehensive income items go home to rest, right? Okay. So what happens? So in this question, it's a little annoying because first they're talking about the income statement, and then they're talking about other comprehensive income in shareholders' equity. Yeah, after I close it, but it does get reported on the statement of comprehensive income at some point. It stops there. Next year, everything starts at zero, of course, on my comprehensive income statement, on my income statement, on my statement of other comprehensive income. Okay? All right, so hopefully that helps to kind of clear up the difference between accumulated other comprehensive income, which is the accumulation over years, as we saw in some of those other questions, and my other comprehensive income in any one certain year. Okay? Okay, good. Now you come over and we take a look at number 16. And if Pop Company owns 15% of the common stock of Sun Company, the Pop Company typically would do what? Well, under the fair value method, which we would be using because we haven't crossed that 20% threshold yet, or got into the 20% threshold, right? 20% or more, we're going to use the equity method, would record dividends received from Sun Company as investment revenue. That is the source of your dividend income. Again, you could have what? You could have unrealized holding gains and losses for a stock. Those unrealized holding gains and losses go straight to the income statement. Okay? Okay, good. Come over, and number 17, if Pop Company exercises significant influence over Sun Company and owns 40% of the stock, now we're well past that 20% threshold, and the answer here is C, would record 40% of net income Sun's investment as income each year, right? Equity method. You take your percentage of the income, your percentage of the dividend, and that goes directly to the investment account, okay? Which sort of answers my next question here. Equity method, you receive dividends, unlike the fair value method. Now we're below the 20% threshold. That is not going to be considered income. That is a reduction of the investment account, okay? And then to get some practice with some numbers here, let's look at this question. So we've got this Tremin Company, and Tremin Corporation acquired 40% of the shares of Delaney Company. Okay, here comes the equity method. Tremin paid investment of $3 million for the investment, and the amount is exactly equal to 40% of the net book value, identifiable net assets on Delaney's balance sheet. Great. Delaney recognized net income of $1 million for 2018 and paid $150,000 dividend each quarter to its shareholders. After closing entries are made, investment in Delaney. Okay, they're asking me for the investment account. So I know I got to set up the investment account over here. and I know they bought the investment for $3 million. So that's how it started, right? And I look at the answers, can't eliminate any because there's none under $3 million, because I know it's going to be $3 million because there wasn't a loss, there was income. Okay. Now the next trick here, and why this is an important problem, they say that the subsidiary Delaney had net income of $1 million, right? We're doing the accounting for Trimman here. Delaney had net income of $1 million. Okay, but what happens? They only had that stock for half the year. So I don't take the full million because they bought the stock July 1st. I take 500,000, and then I don't take all of the 500,000 because I only own what, 40% of that stock. So what's that, 200,000? Okay, so they will debit the investment here, 200,000 for this, and they will credit investment income, equity method, that gets reported on the income statement. Okay, so there's that 200,000 for the investment. Okay, and I start eyeballing question A, but then I have to reduce the investment for the amount of dividend. And okay, so we have now what? We have this 150,000, right? And this question tells us here that the dividends were 150,000 each quarter. But again, we only held this investment for the last two quarters of the year. And so I'm going to take that 150,000 times 2. That's going to give me what? 300,000. But I only own 40% of the company. So that whole 300,000 is not my total dividend here. I'm going to get what, 120,000, 40% of that. So I debit cash 120,000. I credit investment 120,000. Okay, and when I credit the investment, because remember I'm trying to answer the investment account question here. Sometimes it's even hard to remember what it is they're asking you for. Okay, and what, 3,200,000 minus what, the 120,000 means that this investment account is going to have a balance. I'll write it over here. A balance of what, 3,080,000. Okay, which is choice D. Okay, and they say that's hard. I don't agree with that. That's not that hard once you practice with those enough times. I guess what was hard, and let's just understand the main takeaway here. What was hard about this was what? That they bought the investment halfway through the year, so you only take half the year from the time they bought it. They bought it on October 1st, October, November, December. Then they would have only held it for a quarter of the year, and so on. Okay. All right, good guys. Hopefully that is helpful. I will do my best to get this thing markup posted up like this, so you can follow some of these notes we made. And of course, by now you've seen the video. Okay. All right, guys. Good work.